Welcome to Under the Basswood Tree with Basswood Counsel, a podcast where we bring you brief, valuable conversations and insights to help you navigate the complex world of business transactions. From cross-border deals to international tax structuring, we cover topics across all industries. Our team and colleagues will share their insights and provide practical tips on key issues for you and your business. Let's get started.
Hello, welcome to another episode of Under the Basswood Tree. This is Basswood Counsel, built for what's next. My name is Jyoti and I have Chris Klug with me. Chris, great to have you here. So today's discussion is especially important for US persons living abroad. So we will understand how US taxation works for them. Chris, let's start.
Hi, Jyoti. Great to be here. Very happy to be doing a podcast with you. This is a very important topic. It really came to light probably early in 2010 with the passage of the Foreign Account Tax Compliance Act. You know, it's been in the law since the 1800s that U.S. citizens have to pay taxes no matter where in the world they reside, but it just wasn't not a lot of people knew about it. So, you know, back in the days where you rode a horse around town, people weren't really understanding that, hey, maybe I'm in India, but I was born in the U.S. I had to file a tax return. A little more difficult in those days. This is really where we built as a firm one of our deep client bases because there's a lot of complexities that go along with it, different forms, non-U.S. income. I'm pleased we're talking about it today, Jyoti.
Yeah, so I've come across many people who are in India and then they are holding a green card or they are having a U.S. citizenship. They believe that they are not staying in the U.S. and they don't have a filing requirement. So how taxation works differently for U.S.? I understand that there is a residency-based taxation for other countries. So how U.S. is different?
So U.S. is different than about every other country in the world, about one or two other ones. And so I understand U.S. files citizen-based taxation. It means if you're a U.S. tax resident, such as a green card holder, or a U.S. citizen, even if you're living abroad, if you meet the filing thresholds, you have to file a U.S. tax return. Whereas most other countries in the world, almost every single other country in the world, has this residency-based tax system where if you're resident in that country, you're subject to tax on either worldwide income or some other formula of taxation. And so with the citizen-based taxation, it catches a lot of people by surprise. And the other two countries, one is Eritrea. My understanding is with that you get universal health care. We don't get that in the U.S. And the other one I understand is the Philippines. I've heard mixed on that, but other than those two countries, the U.S. is the only country. Those three countries are the only countries that have the citizen-based taxation, and it catches a lot of people by surprise.
That's interesting. So, like, if someone is filing U.S. tax return while they are living outside, so do they need to include only U.S. income if they have, or they have to include like foreign income as well?
They have to report their worldwide income from whatever from any source. So that's U.S.-based, U.S. source income, foreign source income. Now, the sourcing of income, where it comes from, is important, as we'll talk about later, when it comes to the foreign tax credit. So there's mechanisms to avoid double taxation, not necessarily overtaxation, but mechanisms to avoid double taxation if you're outside the U.S. or you have non-U.S. source income. And so that's important to understand. Just a quick question, Jyoti. Based on your experience, do folks in India who happen to be U.S. tax persons, whether residents or citizens, are they caught by surprise from your experience?
Yeah, I think they believe that they are not required to file any U.S. taxation because they are not living in the U.S. But I've seen cases where they are not filing for many years and then suddenly their kids are studying in the U.S. and then they need their U.S. tax returns in order to file some relief in the fee, FAFSA or something like that. So then they
It sounds like you got a kid in college.
Yeah. So then they realize, okay, I need to file the taxes in the US. So that's one instance. And another is like when they get some income from their investments back in the US, and then suddenly they realize, okay, I have to file US tax returns. So these are the instances which I've seen when they feel that there is a need to, and then they caught by surprise, okay, they had to file this always.
Yeah, I mean, people in that situation where they haven't filed for some time, I get a lot of questions about what they should do. I tell them to go to the closest police station and turn themselves in. No. No, and we'll get into it later. There's some compliance procedures. And just, by way of how our firm works, we focus on what we call kind of innocent non-filers, people that have reasons to have income outside the U.S., such as someone in India who has lived most of their life there. All their income is from employment in India. Their investments are in India. Not someone that lives in the U.S. and has been stashing money in some offshore tax safe haven. It's been all of our client base have been the people that we consider to be innocent non-filers. So we take it very personal to work with these individuals and make sure that they're handled correctly and they understand how they can be compliant, avoid penalties. For some of these people, they hear some of the penalties that could apply, and it scares them. And so we try to deal with them on a human level and let them know it's going to be okay if they go through our advice.
Yeah, so I was just wondering, like, are there any thresholds when the filings become applicable, like for 2025, or what are the thresholds?
So, I mean, does your 2-year-old kid who happens to be a U.S. citizen have to file a tax return?
Yeah, no.
They do not. So luckily we have some boundaries here. So there are filing thresholds. And so if your income exceeds the filing threshold, you have to file the U.S. tax return, or you're required to, whether or not there's actually going to be any tax due. So for a single individual in 2025, the threshold is $15,000 in income. Married filing jointly is $30,000. Married filing separately, threshold is $15,000. Head of household is $22,500. And those thresholds are slightly higher if you're over the age of 65. You should check to make sure you do or do not have a filing requirement at that point. But you want to be aware of that. And if you're close, you may just want to file. It's just important to get those tax returns filed.
Okay, and does this include like all kinds of income, like wages and capital gains, interest, etc.?
Yeah. So in the U.S., you're taxed on all income from whatever source derived. And income is very broadly defined in the U.S. And so what you do is you start off with kind of any accretion to wealth, anything you received is kind of income, unless there's an exception found in the Internal Revenue Code that accepts something from being taxed as income. So, one example can be a municipal bond, and that's more of a separation of state and federal government, that the federal government can't tax your state bonds. But yeah, so for the most part, it's any income that's received unless there's an exception.
Okay. Another thing which I get from people, they think that they are going to be doubly taxed on the same income, like because they are residents in India and they're filing their taxes, including everything, reporting everything and paying taxes. So are they really doubly taxed on the same income?
So it can depend. They are not for the most part. And let me ask you a quick question. In India, what's kind of the income tax rate for individuals?
It's around like maximum rate goes until 34% or something like that, and depends on like if you want to pay, if you're paying surcharge or not. So yeah, so you can roughly say more than 30%.
Okay. And so what we'll get into, and it kind of ties in nice with this, there are ways to mitigate double taxation in the U.S. And so if your preparer knows what they're doing, or if you know what you're doing, you shouldn't be double taxed. Now, if the U.S. taxes at a higher rate than where that foreign source income may be earned, then you'd get a foreign tax credit for the foreign source income. Let's say that's $7. U.S. tax is $10. You pay $7 to, let's say, India, and you pay $3 to the U.S., 10 minus 7. And that can play interestingly in like, depending on what the country's tax brackets are. So do they start at maybe 20% and they move up to 34%? In the U.S., we start at 10% and it moves up to 37%. There's some specialty tax, such as the net investment income tax. And where I say, if you have some state income tax, at the federal level by statute, and most income tax treaty, all income tax treaties where we have the treaty partners, there's allowed a foreign tax credit on foreign source income. So in the U.S. by statute, that's allowed with the exception of a few countries. But a state, even if it's with a taxes in a country where we have an income tax treaty, states don't have to follow. So states in the U.S., they have state income tax. They do not have to follow income tax treaties. And most states do not allow a foreign tax credit. And so if there's stated income tax involved, there could be some double taxation, as we call it. And the basis of double taxation, I gave an example how we use foreign tax credits to mitigate. But double taxation really means if you got $1 of income, India is going to tax it at its 34% rate, and the U.S. will tax the same dollar at 37%. That typically does not happen. Now, with the let's start with the foreign earned income exclusion. So this is a special exclusion for people who are outside the U.S. for a certain period of time, and they can exclude their wages, essentially, or self-employment income for the most part. And they can exclude up to $130,000 on an annual basis. So that's increased by inflation. And so if your only income in the other country is wages, there's going to be no tax due. We also, from a planning standpoint, have used the foreign earned income exclusion where the employment income in that country is enough to eliminate U.S. tax. But when you go to their investment income is tax-free, but the U.S. is taxing it. And when you do the foreign tax credits, they're split into categories. So you end up paying a small amount of tax on the investment income in the U.S. But if you use the foreign earned income exclusion to bring earned income down to zero, if the investment income doesn't exclude $15,000, you've now planned around that tax and owe no tax again. Or $30,000 married filing jointly. So going through the thresholds. So that's a very important exclusion. Along with the foreign earned income exclusion, there's another part to it. Called the foreign housing exclusion for the right situations. Now, you also can get a foreign tax credit. So with the foreign tax credit, you're going to credit against your U.S. taxes paid to another country such as India on foreign source income. So on the U.S. side, you can only take a foreign tax credit in proportion to your U.S. income tax that's related to foreign source income. So you're going to be allocating and figuring out what income's foreign source, what income is U.S. source. And that's going to come from statutory rules that apply to the foreign tax credit. And then also the tax treaties has some sourcing rules as well. So it's important to understand it. And from a planning standpoint, if foreign tax credits were to eliminate your U.S. tax obligation, a lot of times it's better to use the foreign tax credits.
So I have a question here, like, for example, if somebody is having only wages or self-employment income and that's below this threshold, so they just can't assume automatically that they are not liable to file, like they need to file the tax return in order to claim this exemption. Am I right?
Correct. Yeah, you have to file the tax return to claim the foreign earned income exclusion. And it doesn't reduce the amount in determining whether you meet the filing threshold either. So you have to file the tax return.
Perfect. So another area which I would like to discuss is about FBAR, like filing of foreign banks.
Yeah, so the FBAR filing requirement, it's been around since the 1970s, maybe even before. It's not that difficult of a form. It's just information on your non-U.S. based bank accounts. It's important on your tax return because this can catch people that they don't even realize it. The tax software, most tax softwares, on Schedule B, it asks you, do you own any foreign accounts? Let's dive into that question. If you live in India and you happen to be a U.S. citizen, but you're living in India, would you think your Indian bank account is a foreign account?
Yeah, I think so.
Well, technically, for the tax return purposes, for that question on Schedule B, it is. But to me, foreign means you own an account outside the country you're living. And so if you're living in India and you only have Indian-based bank accounts, I wouldn't necessarily think I have a foreign account. But from the U.S. perspective, even though it's not defined on the tax filing, they mean any account outside the U.S. And then the next question on that Schedule B is, do you have a FBAR filing requirement? And by default, tax software will mark those answers as no, TurboTax, whatever it might be. The problem with that automatic answer is the IRS, if they were to come after someone, uses that question to determine as an indicator that you willfully failed to comply with your U.S. tax obligation. So the way we do the FBAR if you add up all your non-U.S. based accounts, brokerage bank accounts, if at any time during the year the max balance exceeded, when you add them all together, $10,000 equivalent U.S. dollars, then you have to file an FBAR. The non-filing of the FBAR carries penalties up to, for innocent non-filing, $10,000 per year for not filing the form. And for willful, it could have criminal penalties. It can also be up to 50% of the accounts. And there was a good Supreme Court hearing ruling on this. So there used to be a debate whether innocent non-filing, the $10,000 penalty was per account per year. So if you have 15 accounts, it could be $150K per year.
That's huge.
That is huge. Or if it was $10,000 per year. So the Supreme Court says $10,000 per year finally. And you're right, it's huge because guess what? In determining this $10,000 penalty, we haven't even examined what's the value of the account. So if the account, you have a $12,000 account, fail to file, and you get hit with a $10,000 penalty, that's more than the criminal amount of 50% of the balance. So,
Oh, yeah.
so the penalty is not actually based on account balances.
Okay, so let's dive right into deadlines. What are the filing deadlines of people living outside of the US? Are they same or they are different?
So it's interesting how they word it, but for someone residing outside the U.S., you get an automatic 2-month extension to both file and pay the tax due on your tax return. So without filing anything, they can get until June 15th to pay their tax due and file the return. Now, it's very important to note this because doesn't make sense that even though you have until June 15th to pay the tax, that means there's no failure to pay penalty that starts to accrue. But if you don't pay the tax by April 15th, interest accrues from April 15th. And that doesn't make a whole lot of sense. I actually spoke with the IRS, some pretty high up officials about it. And at first they're like, oh, no, that doesn't make sense. And then they're like, and then they kind of changed their mind on the issue. So it doesn't make sense. So if you on an annual basis, you end up owing U.S. tax, you want to pay attention to April 15th. So going back, you got automatic 2-month extension to June 15th. You can then file an extension to October 15th. And with the permission of the IRS, you can get an additional 2-month extension to December 15th. We've filed that additional extension asking the IRS permission on a number of occasions. Not once have we ever received a response. And so it's kind of, you file it if you need to for a client. Obviously, we'll try to get done by October 15th. But, otherwise,
December 15th.
that you can get to December 15th. Make sure you request it. I don't suspect anyone will get a response to it.
Yeah, I've seen it's usually not practical to file by April 15 because people in India, they have another filing deadline. So they'll file their tax returns until July or September. And then usually they file a U.S. tax return after incorporating their income. So yeah, so practically like October 15 is the date when usually the filings are completed.
Yeah, I mean, I think that's a key thing. What's the filing deadline in India?
It's
and how does it
July
work?
for salaried people and
Okay.
September and October like for business.
Okay.
So yeah,
Interesting. And
so they can just estimate their taxes and pay them by June 15 and then they can file their tax return.
yeah, that's been our experience with most of our clients that are outside the U.S. is you try to file the country of residence taxes first because that's where you'll get most of the foreign tax credits that will apply to the U.S. tax return. And then
Yeah.
you file the U.S. tax return.
Okay, so there is something about FATCA reporting. I think we have already discussed about FBAR, but what is FATCA reporting?
A lot of people have probably heard about the Foreign Account Tax Compliance Act, which we call FATCA. There's both an individual reporting and then there's an obligation we stuck on non-U.S. financial institutions. So if you're residing outside the U.S. and you're a U.S. citizen, you might have had banks kick you out. So you can't open a brokerage account here. You can't have a bank account here. And you might feel awfully lonely that no one wants your money. But that's because on the bank side, we forced through this law non-U.S. banks to report their U.S. account holders and specific information. If they did not report their U.S. account holders, they would have to be subject to penalties on any kind of income that flows through the U.S. tax system, which is it could be a heavy penalty. And so they set up these extensive systems to report their U.S. account. On the individual side that goes with the tax return, you have to file what's called a Form 8938 if certain thresholds are met with certain non-U.S. based assets. And so that's the individual compliance part of the Foreign Account Tax Compliance Act. There's a lot of overlap between the FBAR and the individual FATCA compliance on Form 8938. You report your bank accounts, you report your brokerage accounts, and then it includes other things called specified foreign assets, and that's interest in a privately held foreign company would be included that value. And so, you have to file that form if you're single and living outside the U.S. Those assets, when you add them together, exceed $200,000 at the end of the year or $300,000 at any time during the year. And for married filing jointly, it's $400,000 at the end of the year or $600,000 at any time during the year. And just as kind of as a rule of thumb, if you're close, we recommend the clients file a lot of the information you already had to input for the FBAR. And so you don't want to get hit on penalties on some non-issues. So it's easy enough to report. You should just report so there's no issues.
Yeah, I've seen like people, they know about FBARs, but they generally miss about filing FATCA reporting. So this is a good information for our audiences.
Another good reason to go to that police station and turn yourself in. No.
Okay, now come to some complex issues. So I've seen people, they are US people, and then they have some companies outside of the US, and they have some filing requirements around that. So could you explain something about?
Yeah, absolutely. One that catches a lot of people by surprise, and the IRS has lessened the burden on this, but technically that non-US based retirement accounts, a lot of times they're considered foreign trusts because you have a third party administering it for the benefit of the beneficial owner. And so that meets the definition of trust. And so since it's outside the US, there's a special form that needs to be filed, may need to be filed. There's some things you got to jump through. But the IRS gave a ruling that says even if you're supposed to file it, for most foreign retirement accounts, you may or may not need to file it if they fall in certain guidelines. Or if you just have a foreign trust, you have to file this Form 3520. And Form 3520A is something called a grantor trust. These are all things we're going to analyze. With the pension account, you have to determine whether it meets the definition of something called an employee trust. If it does, income's tax deferred, and you don't have to file the form. If it's considered to be a grantor trust for tax purposes because it doesn't meet the employee trust definition, then you need to look at the assets. And one of the problems there is a grantor trust, and it holds mutual funds and that are non-U.S. based, and you have PFICs or passive foreign investment company interests that are very complicated to report and very complicated tax implications. So it's important to understand whether you have a filing obligation and how they're taxed. And so those forms are for both foreign trusts and pension accounts. They may or may not need to be filed. One that's more common, deal with the foreign corporation ownership outside the U.S. So there's a Form 5471 that covers some people know about controlled foreign corporations where U.S. people own the majority interest in a non-U.S. Corporation. There's what a U.S. shareholder has its own definition, but there's 5 different categories you could be classified in requiring a Form 5471. For some of the categories is essentially filing a corporate income tax return as an informational return being attached to your U.S. tax return. So one that goes along with that Form 5471 in the initial year is Form 926, which is to report contributions to a foreign corporation. For foreign partnerships, a Form 8865 needs to be filed. Again, this is kind of an informational reporting that's partnership tax return attached to your individual tax return. And then there's I think it's Form 8858 for foreign disregarded entities. And then for, I mentioned reporting of foreign mutual funds or interest in something else that would meet the definition of passive foreign investment company. That interest gets reported on a Form 8621. There can be some punitive tax regimes that are attached to it. There's the deferred tax. You can make an election for mark-to-market, qualify electing fund. And so there's some different opportunities there. But if you go by the default regime for a PFIC, it can be quite punitive. So it's important to both understand what are the tax implications And what are the compliance requirements?
Yeah, this is the most burning issue. And people are surprised to know that they have to pay taxes on the foreign mutual funds, even if they have not sold them. So yeah, they were like, why do I need to pay taxes on, like, I haven't sold them yet? So we have to explain them that how U.S. taxation works around the foreign mutual funds.
Yeah, because a lot of mutual funds will do automatic dividend reinvestment, or the other thing that comes up is they'll take their administrative fee out of the mutual fund, and that's technically a distribution out, recontribution to pay the fee. So even if you got nothing from the foreign mutual fund the whole year, the fact that it took a dividend out, or that fund used the assets in there to pay the administration expenses, can trigger the tax as well. And so it's quite complicated, and it's important to work with professionals, or if you don't understand the reporting, it's important to work with professionals that understand how to do it. What I see in the preparation in this area is a lot of US-based CPAs don't get enough client base to really understand the rules. And so when they kind of dabble in it, mistakes are made. And not CPAs, sorry, tax preparers, US-based tax preparers. Or if it's tax preparers that are licensed outside the US, they deal a lot more of these issues, but they don't have the deep knowledge of kind of the U.S. tax education sometimes. And so you see they get the forms right, but some of the reporting's wrong. And so I just dealt with a client. She went to someone in her home country, thought she did a good job, and then I reviewed it and noticed the controlled foreign corporation reporting was all wrong, and some other items were wrong. And unfortunately, we see that often because it's technical. So it's
Yeah.
important to work with people that know what they're doing, right, Jyoti?
Yeah, absolutely. Because I believe that there are significant penalties if you don't do them, like do the filing correctly. So it's better to consult a person who is expert in that.
Yes. Yeah. Just for example, for the FBAR, we talked about non-willful non-filing, meaning not on purpose. It can be a penalty of $10,000 per year. Failing to file the FATCA Form 8938 is the initial $10,000 penalty, and it could be, if you get a notice from the IRS, you can tack on $10,000 over certain periods, up to $50,000 a year. Form 3520 is the greater of $10,000 or 35% of the reportable amount. And Form 3520A is the greater of $10,000 or 5% of the trust assets. I just want to pause on that one real quick because we had an interesting client situation come up. Form 3520 is the trust reporting. And we had a client that formed a trust in a certain country because it's common to have home ownership through a trust. But the home had been developed. What they actually had was an option which was not held by the trust. And 5 years down the line, this property would be built. And then that, upon completion of the property, it get transferred into the trust. This client wasn't aware of a 3520, 3520A filing obligation. And they were actually right, even though they just weren't aware of it. And then they went to someone, probably, in my opinion, a novice in the area, who said, you must file the Form 3520, and now it's being filed late. They didn't do it through any compliance procedure. The property was the equivalent of about $2.5 million US dollars. And so they got hit with a $900,000 penalty. And they have an asset that they have nothing in the trust. And all they have right now is they paid for essentially an option, but they treated the value on the Form 3520 and 25 and 20A as if it was worth $2.5 million, which is what it would be worth once they paid all the money. So right now they have a $2 million, whatever, minus the initial deposit. They have an obligation over $2 million, but they got taxed as if there's a full valued asset at 2.5. We're working our way through to try to get those penalties removed, but they can be extreme. Form 5471 and Form 8865. Penalties are initial $10,000 penalty, and they can go up to $50,000. And for Form 926, again, I think it's a $10,000 penalty up to, or 10% of the value transfer, up to $100,000.
Okay. So now the question is, if someone hasn't been filing for years, so what they can do, like Are there any schemes available where they can avoid penalties
I'm
and
gonna
willful declare it?
I'm going to stop with my joke of going to the police station. So I'll stop with that. But yes, there are good compliance options. And I say, when some of these compliance options were being developed, I was with a firm where me and one other person at the firm were talking to the official that was in charge of creating these programs. And we had good input. They're good ones depending on the situation. So it's important to understand the options. So if you're a U.S. person living outside the U.S., there's a streamlined foreign offshore procedures where you file 3 years of income tax returns. You file 6 years of FBARs. We usually attach, it's not a reasonable cause statement, but you attach a statement explaining why. We call it a personal statement of why you didn't file. This fits really well with our category of innocent non-filers. And by filing through that procedure, again, if you qualify, there's no penalties. So that's a big advantage, and then you just need to be current going forward. Then there's, if you live in the U.S., there's effectively the same procedure, but they have a 5% base penalty. And so 5% penalty for the highest value of your non-U.S. assets during that period. And this is one that we pushed back on the IRS, but they didn't care. In our opinion, if you're innocent, why should you be penalized because you lived in the U.S. as compared to not living in the U.S.? Regardless, that is the procedure. Now, there's another one called the delinquent international informational.
I think when you opt for these procedures, then you save penalties. But if you have tax payable, then the interest is something they will be required to pay.
Yes, so if they're very good point. If there is tax payable, then there's interest to be paid. Now, especially for someone residing in the U.S. where there's a 5% base penalty, if you reported all your income on your tax return, but you just failed to file the FBAR or the Form 8938, there's a delinquent international informational return submission procedure. I think I got that right. I should have written it down. But through that, you can file the informational returns and you have to file a reasonable cause statement. And then you should be able to avoid penalties. It's not automatic. So this is interesting. If you had unreported income and you go through the streamlined foreign offshore procedures, there's no penalties. If you go through this one where you reported all your income, but you just forgot some of the forms, you can get hit with, they shouldn't, in all cases, we've never had anyone get hit with the penalties through it, but you can be penalized because it's based on a reasonable cause statement. The IRS, a lot of times, will process the forms and resulting in penalties being issued. Then you just have to go back and forth to get the penalties removed. And finally, there's a delinquent FBAR procedure where if you filed all the other forms and reported all your income, you can file your 6 years of FBARs under a separate procedure and not be subject to penalty.
Perfect. Okay, so let's wrap up. What's the key takeaway?
Key takeaway is, I would say understand your tax reporting obligations. If you're not fluent in tax, which is a true skill, then you're going to want to work with a professional. And you want to work with a professional that knows what they're doing. And that's tough because obviously most professionals will know more than someone who doesn't have a tax background. And so it can sound like they know what they're talking about, but they do not. And so how do you know if you're working with someone that knows what they're doing? Well, just because you end up owing no tax doesn't mean that person knows what they're doing. And so
exactly. So it's important to understand your tax situation and consult a professional tax person who can guide you with the just so that you don't end up paying penalties later on. So, yeah.
Yeah, that's correct. And you just want to make sure you're on top of it. So it's make sure if you're not sure, you talk to someone that knows what they're doing, and then just make sure you're doing the annual filings. And one big thing is as you get new assets, especially outside the U.S. or new source of income, make sure you let the professional know to make sure there's no special reporting regimes, no additional forms, no punitive tax regimes that you're worried about.
Perfect. Okay, so thank you for joining us on Under the Basswood Tree. If you found this episode helpful, share it with others. See you next time. Stay informed and stay compliant.
We hope you enjoyed this episode. To stay up to date with the latest legal insights and Basswood events, please follow us on our Basswood Council LinkedIn page and visit our website at www.basswoodcouncil.com. Thanks for tuning in, and we'll speak to you next time.